Everyone, it's 5 o'clock, and I'm delighted to welcome you all to the first webinars in a series of 5 on the topic of raising venture capital with impact. For those who are joining us for the first time, I am Luísa Ferreira, Head of the Social at the European Investment Bank Institute. One quick word on the Institute. The Institute is the philanthropic arm of the EIB, the EU Policy Bank. I will be your host for today's webinar, and it's my pleasure to introduce you to today's speaker, Wladimir Nikoluk, who will be the speaker for the 5 sessions. Wladimir is the CEO and founder of emerlearn, an advanced data analytics consultancy that helps entrepreneurs and investors and social innovators to manage and increase their impact. Wladimir holds a master's degree in public policy from the Harvard Kennedy School, where he was awarded the McCloy Fellowship of the German government for academic and social achievements and the Adrian Cheng Fellowship for Social Innovation. Before, he was a consultant at the McKinsey Company, and he has also worked as a resilience intelligence officer for the UN in Jordan. Wladimir holds a BA from the University of Oxford and is a member of the World Economic Forum Global Shapers, as well as of the German National Academy Foundation. With these 5 webinars, we aim to explore how entrepreneurs can successfully use impact measurement to raise funding from existing and emerging venture capital funds. Today, Wladimir will kick off with an introduction on the topic. Before I give the mic to Wladimir, some few logistic remarks. The first one is the webinar is being recorded and will be available in a few days in the Institute's YouTube channel, together with all the webinars we have developed for the SIT Alumni Network and other social entrepreneurs in general. Second, and because this happens, if you have any issue with your audio, please make sure it's connected or please rejoin the call. Usually it solves all the problems. Final one, how can you interact with us? You can either use the raising hand option, you can use giving other type of feedback or chat and Q&A. I will ask you when you use chat and or Q&A to use the option send to all panelists. And at the end of the webinar, if you have questions for Wladimir, please use Q&A rather than chat because it will make the handling of all the questions easier. Finally, at the end of the webinar, we will be asking you to answer a short survey. And I guess this is all for now. Thank you, and now I invite Wladimir to join us. Wladimir, the mic is yours.
Excellent. Well, thank you so much for having me here. And it's just really a pleasure to kick off this webinar about a topic or an intersection of topics, namely data, entrepreneurship, and impact that I'm personally that I'm very passionate about. I'd like to extend my thanks to Luísa and the whole EIB team for making this possible. And I'd like to start by just giving you a quick overview of the webinar series as a whole. So as Luísa said, today we are really kicking off with an introduction. Our goal here is to really lay the foundation to understand the various stakeholders that exist in this VC impact investing space, what drives them, where we are in terms of funding, in terms of maturity of impact management, and where we are likely to go. And then using that foundation really in the later stages to build a much more detailed understanding of the various topics. So specifically in session 2, we will talk about and actually speak directly with VCs that were traditionally kind of not impact focused, but are now starting to build impact verticals and try to understand how they make their decisions to actually go into the space and how that influences the way they do their due diligence and investments. Then in the next session, we will talk with VCs that actually have emerged in the recent years to do exclusively impact, right? That have never done anything else, and to try to understand where they are in their process. Then we turn to a very important question, which is how do we actually measure the impact of startups? This is a really tricky question, specifically because there is always a trade-off between burdening a startup team that is already very busy, but also trying to get the type of insights that would actually help the startup itself, but also help the investor. Lastly, we'll have a session to tie in all of those insights together and to really create this kind of very practical recommendations of how to build your impact management system if you're a startup or if you are a VC. So before we jump into today's session, I'd just like to share my personal story of how I came to care about this intersection. In 2014, I was working, as Luisa already said, for the United Nations Development Program on the Syria crisis. And at that point, we had a budget of $2.5 billion. And our goal was to stabilize the countries surrounding Syria. So Iraq, Jordan, Egypt, Lebanon. And we faced a shortfall, like 40%, despite of actually having a lot of money. There was a question like, how do you prioritize the various programs that exist? And we were lacking a little bit the impact insights to do that. And so that really left a mark on me. And in my whole kind of follow-on professional career, but also in my academic career later on at Harvard University, I focused very much on how do we use data to actually understand the impact of services and goods and whole organizations. And that's why I founded Immerlearn in a way to bring those advanced analytics and impact management services to the social and public sector, but also investors and startups. And really the objective is to create a better impact accounting system as a whole. So with that in mind, the agenda for today is really the following 5 questions. So what is actually impact investing and how would we distinguish it from other types of investments? Second, where does demand for impactful products come from? Third, how is it that a lot of talent has started actually flowing into the sector? Fourth, what impact kind of like funds and verticals have emerged in venture capital over the past years? And then lastly, like what is the foundational framework that we could use to understand and measure the impact of startups? Now, impact investing as a whole, and specifically also for VC, really has a fairly simple definition. Those are investments made with the intention to generate positive, measurable social and environmental impacts alongside a financial return. And you heard this definition before, but it sometimes gets a little bit confusing because there's so much other words out there like ESG and negative screens and positive screens. So I think the first thing really to note is that impact investing is actually quite a sophisticated form of capital. So if you look at just the way global investors actually label their investment strategy, by far the biggest pool is something called negative screen, right? So this is not really impact investing because it just focuses on excluding certain industries that you know are kind of bad for society or the environment. That might be something like tobacco or weapons, or to some extent also defense. Then there is another form of capital called ESG integration, about understanding what it means to be a responsible participant in the economy, right? So how do you treat your staff? How diverse is your workforce? How many emissions do you have in terms of tons? How do you treat product liability? All of those things really help investors understand, is this a responsible company and at least doesn't do anything negative? And then there is positive screens where we consider whether certain players actually do best-in-class practices to reach a certain impact, right? So we might, for example, think, well, we want to improve the food safety in a certain region, and there might be 2 interventions that actually focus on this outcome, but one has much more research behind it that is actually effective than the other one. So that would be positive screen. And you can see the vast difference, right? Like that's a much smaller funding pool already than the ESG integration was before with 17 trillion. And then lastly, we have this inner core, impact investing. That's really a holistic approach to understanding how a product actually influences society along all possible impact indicators. And so with this kind of sophistication in mind, let's dive a little bit deeper into how this industry has actually evolved. Now, before we continue, we have our first poll. And what I would love to ask you as the audience is, what do you think, right? Like, how much has this sophisticated asset class called impact investing grown in the last 8 years? And you should see the poll coming up right now. And then I might have clicked it away, Denise. So maybe you could just share what the results actually were. Perfect, fantastic. All right, so we have a huge variety of answers, and I will just read it out to you because the slide, the following slide it's hard for me to edit at the moment, to be honest. Just give me one sec. But we have essentially people thinking that it might be C, some people thinking it might be D. And actually, the ones who are right is actually the people who think it's D, right? So it's actually by a factor of 90 that impact investing has really grown. And this is quite a remarkable growth, right? Like just in 2012, it was 8 billion. 8 billion is already a pretty huge sum. But in 2020, we're already at 715 billion, right? So there is a lot of interest in this type of products, right? That really take the social and environmental impact seriously. And then that raises essentially a very natural follow-on question, which is, where does this demand come from? Why suddenly are people interested, right? Now, before we dive into that, I think it's important to acknowledge the type of economic system we actually have as a society. So in our system, we have an incredible optimization machine, right? But our economic system really optimizes for profit and revenue and shareholder value. And it does so incredibly well. And we have essentially also produced a lot of great results with that, right? If we look at just the last century, we have reduced the number of people living in extreme poverty by around 90%. We have cut child mortality by 50%. Even in the worst countries, right, today that still need a lot of help, people live way better than they lived 50 years ago. But at the same time, it's really important to acknowledge that our economic system has also produced a lot of challenges for us. And maybe we've reached a tipping point where the system actually produces a little bit more challenges than actually the solution it creates. And so here are some of the things that people are really concerned about and that really drive the demand for those impactful products. So one is the concentration of CO2, right, at 413 parts per million. It's the highest level since 800,000 years. Another thing is rising sea levels. We estimate currently that sea levels will rise between 0.5 meter and 2 meters in the next decade, which will displace hundreds of thousands, if not hundreds of millions of people. Our pace of consuming resources is extraordinary. We would need 5 planets if everyone was to have the same consumption level as people in Western Europe or North America. We have a huge problem with income inequality. The top 1%, for example, of households in the US have captured 50% of all economic gains since 1973, which is almost 50 years of economic growth, right? That partially went to the top 1%. And at the same time, this has created a class of working poor. Poverty is a huge problem, and over 40% of families in the US, for example, again, are unable to absorb a $400 unexpected expense. At the same time, mental disorders are on the rise. We have the highest rate of anxiety and stress among the Gen Z situation in human history. And lastly, there was a statistic that I read this morning where Antonio Gutierrez, the head of the United Nations, said that so far 10 countries have administered 75% of all COVID-19 vaccines, while 130 countries have not received a single dose, right? So I would submit to you that the biggest source of, in a way, demand for impact is this realization that our world is deeply imperfect and that we need to find better ways to actually improve it at a faster and scalable way. And there is this there is a language to talk about the type of world that we want. And it's codified in the UN Sustainable Development Goals. Most of you have already seen it before. But I think it's just important to highlight that while the UN SDGs, they kind of give us the targets where we want to be, they are not by themselves sufficient to have a good impact measurement system, just because they're such large targets and they fall into those kind of dozens of impact indicators themselves. But they're very useful frameworks to actually think about like where we want to be. And I think this is the type of language we should use going forward. Now, let's get us to our second poll as a result. So what do you think is actually the financing gap for the SDGs? So is it $25 billion that we need extra per year to get them done? Is it $250 billion? Is it $2.5 trillion? Or is it $25 trillion? Let's give ourselves, like another 20, 30 seconds to estimate that. Great. And the results are in, and I'm now going to try to post it so we can actually all see them together. Perfect. Yeah, so the actual answer is C. There is actually a $2.5 trillion gap, which is quite a humongous sum. If you just think about it, this is roughly like 3 or 4% of the global economy output worldwide. And here we have our distribution of the poll. So as you can see, we have like a huge variety of people. So there was a little bit of confusion as to like what it actually is. But the right answer is really the 2.5 trillion. Great. So with this in mind, let's move on. Now, because the world is kind of imperfect and drives the demand for impactful, in a way, products, people and societal stakeholders have really responded in different manners. So investors, for example, have committed more and more of the capital that they manage to have it reallocated from less impactful to more impactful companies. So by today, and you remember the graph that we had earlier, right? Around $31 trillion are committed to at least be reserved for responsible companies. And this is increasing very, very rapidly. And so what you will see over the next years is more and more pressure on those corporations to actually show that they are responsible and to actually prove that their products don't cause harm or might even be beneficial for society. Now, the second thing that is very interesting to observe is the way that philanthropies have responded to it. Though they were traditionally grant-based, but you see more and more philanthropic organizations like the Rockefeller Foundation becoming almost impact investing funds themselves and kind of focusing really on outcome indicators and like paying in a way for the success of a program rather than just delivering a certain service. So for example, in the future, what you will see a lot is that, for example, if you have an education program, people will not pay necessarily to have textbooks distributed, but you will see that you will only get the money if, as a result of the distribution of textbooks, the reading scores of students, the outcomes have actually improved. Now, the corporations, again, are facing some of the most activist environments they have ever been in, right? If you're a corporation, you're now asked to report impact data on a variety of metrics, from the way you treat the climate, the way you treat water, forests, the way you treat your staff, the way your product might be safe or not. There are now so many different impact standards, and in fact, more and more regulation and investor pressure is put on companies to actually fill those out. So one of the most important impact standards called SASB, Sustainability Accounting Standards Board, they have seen their subscription and their reporting rise by 360% only in 1 year after BlackRock, one of the biggest asset managers, requested in a way all the portfolio companies that they invested in to report against it. And you have the same effects or similar effects with other standards like GRI, CDP, and say the EU taxonomy, a regulatory standard that's coming this year. Now, governments are shifting as a result as well. So governments are now, similar to philanthropies, spending more on outcome-based contracts, and you will see something called social impact bonds in the future coming up way more. And impact bonds are just a contract where if you, as an investor and as an NGO, if you can achieve a certain social outcome, you essentially get paid by the government for actually achieving it. And then lastly, we have consumers, right? Consumers purchase goods in alignment with their values. And there are many statistics about how they are actually also switching consumption away from companies that don't closely align with their values. And against all of this background, you have also the entrepreneurs. And the entrepreneurs are building impactful startups with measurable impact and responsible business practices. And we will meet some of them in a bit. Now, there is a really interesting question as to, like why impact entrepreneurship is really taking off. And one of the most important things I would say is that there is just this huge surge of talent, especially in the younger generations, which just is naturally attracted to this space. Part of it is just generational preferences. So if you look at statistics around how people just generally want to kind of live and work and invest, you see that there is a huge preference, right, to pay for sustainable products. But if you then look, like that's the 68%. But if you then look at the generations, for example, the millennials and younger generations, they're twice as likely to buy from and invest in companies and also work for companies that have a positive impact on society. So you'll find a lot of employers right now thinking to themselves, okay, if I want to attract some of the best talent on the planet, I actually need to figure out how I can showcase my own impact to the world. And it's not only that those kind of younger generations are now, the workers and also the consumers, but also increasingly they're becoming the investors, right? So millennials are set to inherit over 30 trillion euros in the next decade, which essentially means that they will become small impact investors, and they will ask their, banks or their wealth managers for products or for investment products that in a way correspond again to their values. And so what you really have in our generation is, for the first time, that there is this breakdown of a trade-off between impact and wealth. It used to be that you had to decide, right? Like if you wanted to be wealthy, you had to go into banking and consulting, and you couldn't do like much good for the world, right? Like all you could do is like try to be as responsible as possible. But in our generation, it's now possible to build companies that create huge business value by actually solving all of those questions and meeting those demands, and that have a lot of impact on this at the same side. And that turns out to be an incredibly attractive proposition for a lot of talent out there. Now, let's meet some of those actually companies that have built it and like what is actually possible to create in terms of the value, right? So if we look into various sectors, like let's start, for example, with medical goods. One really famous company here is Zipline. So Zipline was founded in Rwanda with the idea that life-saving medical supplies, for example, fresh blood, are sometimes really hard to get by in remote areas. So they developed a drone system starting in 2011 that would actually get critical medical supplies very quickly into the hands of people that need the most. And now they are valued at $1.3 billion for just building that service, which is both kind of impactful and like a huge business opportunity. Orcam has actually focused on the visually impaired, like people who for some reason cannot see properly, and they have developed technology that lets them essentially interact with others, right? So they were founded in 2010 and are worth $1.7 billion. Thaler have essentially created microloan products based on phones for people that are underbanked or unbanked, starting in 2012, and they just got a valuation of 800 million now. And then Indigo, completely different field, agriculture, right? Trying to solve this problem of increasing crop yield and relying less on chemicals via microbiology technology. They were only founded in 2016 and are now worth already $3.5 billion. In another one, Andela, sourcing of African talent. So they essentially the founders were kind of concerned that you could only, you actually didn't have the training opportunities for African tech talent to work internationally. So they created training courses for them and started in a way having high quality software outsourcing services in Africa. And they are now worth $700 million. So there's this huge array of social problems that also were business opportunities that were tackled by these companies, and they created in a way a lot of impact and a lot of monetary value as a result in a very short period of time. And those are just like the beginning, right? We could spend all day here and talk about all those kind of like super interesting companies that were founded and funded in the last decade. And this will be part of a session that is coming up. So if you are now a venture capital firm and you look at all of these trends that we just discussed, right? Like, what do you really see? You see this kind of financing gap, right? The trillions that are essentially missing. You see the surge in global talent that is founding those impact ventures. And then there's another piece that you see, which is that there is an over demand and undersupply of kind of genuine and grown impact assets, right? So if you look at, for example, the private equity level today, or even the public market, if you wanted to have an impact, say, ETF, right? You only wanted to invest in impactful companies that actually do something good. It's really difficult to find those companies. I mean, maybe Tesla would be a good example, right? That actually has impact. But all the other ones are mixed at best and probably a little bit like, maybe even negative to some extent. So, and you have a similar problem on the private equity space. So if you look at very large private equity funds, they struggle to actually find genuine impact assets. And so if you as a VC can now, in a way, find those companies and grow them, and you then kind of sell your shares later on to private equity or public market investors, you can essentially charge a premium for that. And so as a fund, you then realize, okay, there's unprecedented demand and market for the product, for the impactful product. There's just outstanding opportunities in terms of finding the teams that meet this demand and build the product. And then there is this kind of like enterprise value that you can increase by actually managing impact better. And so you have two action steps, right? Like if you're an existing fund, you will create a new vertical. And if you are someone that looks at the sector and says, you know what, I don't think there is a home just yet for those impact entrepreneurs, I will just create a new fund. And this is exactly kind of what ended up happening. And before we go there, I would love to have like our last poll and just ask you, how much do you think has investing in a specific sub niche of impact, climate, right, grown in the last 6 years? Great. So the results are in. Let me just again post it so that we can look at it together. Fantastic. So yeah, so here are the results, right? Again, a lot of different opinions, but most of you actually guessed correctly that it's actually D. It's an insane growth, right? Like 40 times more investment in climate tech, 16 billion today than only 6 years ago. And the other interesting statistic about that is also that it's actually 7% of all venture capital funds funds that existed in 2019 actually flew into climate alone. And this is not to mention the investments that went into education, agricultural technology, healthcare, right? And all the other impact verticals that you could actually think about as well. Now, let's quickly, and again, this is going to be 2 sessions, right? Where we're going to take a very in-depth look at how the VC landscape is really changing. But if you take the first 3, those are just traditional funds, and let's focus on Europe for the moment. Those were traditional funds that are now starting to build impact verticals, right? So EQT Ventures is a large Swedish fund, 660 million under management, and also have a private equity fund on top of that. They actually have now introduced ESG in a way processes in their own organization, and they rate every single organization with a 1-pager in terms of the ESG performance and what they would expect. And they are now looking to actually increase the sophistication of that system and build more impact management. Plus, they're setting up a new fund specifically dedicated to impactful technologies. Crandom, again, also a Swedish fund, and Sweden is very well represented when it comes to impact, I have to say. They focus. One of the kind of most famous investments is Spotify. They have a $53 million fund, and they essentially, have now published a really important piece on climate tech, and are really trying to push the climate tech vertical in terms of the investment. La Familia is another fund from Germany, managing 91 million, and they essentially raised kind of this new fund that they raised. They essentially raised it on the impact thesis that sustainability will become a thing. So when they went to the limited partners, they would actually say, well, this is one of the future growth topics that we want to invest in. Then there are pure impact funds. So Ananda Ventures in Germany was founded in 2008, managed 50 million, focused a lot on digital health. Pale Blue Dot is a Swedish fund that focuses exclusively on climate technology. They're very young, founded in 2020, and they are now $53 million large. And then Norskin has a super diverse portfolio set, but it's also pure impact. And essentially their tagline is find the kind of the entrepreneurs that build the biggest kind of, that tackle some of the biggest challenges with some of the most scalable technology on the planet and help them in the way scale. Now, and again, like we will dive way more deeply into all of these topics in sessions 2 and 3. And then here, just to kind of lay also the foundation, let's quickly review the current and most important impact standards that help those type of investors, but also other stakeholders, make sense of the impact of a company. So one very, very interesting project is the impact multiple of money. The impact multiple of money essentially tries to quantify the output and outcome relationships, right? So for example, if you are the provider of an online training in education, it would say, okay, like you have trained a person, but then what's the average increase in the salary as a result? And so if you can find this factor, right? Like if you train, your salary increases by 10%. If you find this factor, it's actually possible to just overlay that piece of knowledge with the overall growth trajectory of the company. So for example, if you serve 10 million people this year with this product, and they all increase, they have an average salary of say 30,000 euros, and that all increased by 10% as a result of your training, right? You actually know like how much value you have created for them. And so the impact multiple of money then says, okay, well, take that monetary value and divide it over your investment. And if you invested, 10 million, and the value that you will create over time is 500 million, then you have a certain multiple. And if that multiple is high enough, we will invest. So one of the most famous funds that actually invented this methodology is called the RISE Fund from the United States. Then there's life cycle analysis. It's a very comprehensive assessment, right? From the birth of a product to the death. Like what impact does it have to produce it, to actually get the resources into one place, to then consume it and then kind of dispose of it. So it's a very, very kind of sophisticated piece of analysis, and essentially it creates, according to each indicator, it creates a certain evaluation, if you will. That's why it's called multi-indicator. The impact management project, IMP, is a more standardized framework that asks you to consider a set of questions. This, I think, is currently being done by most funds, where they kind of consider, is this like a stakeholder that is kind of benefiting from it? Is there some systemic change? Have we understood the whole environment in which this product is deployed? But it can be very qualitative, right? It can be detailed if you want to, but you can kind of get by having just a couple of sentences to each of those questions, and you would be done with the IMP. Which is why I think it's a great umbrella framework, but also maybe there is some doubt as to like whether it's a great decision-making framework. And then there is the IFC, who published the Anticipated Impact Measuring and Monitoring Framework, which essentially gives you a score. It has multiple dimensions, so we'll dive into them way more deeply. But essentially says per investment, per company, like what's the score? And you then as an investor can say, well, the score goes from 0 to 100 and my cutoff is say 70. And if your investment doesn't reach 70 score, then you would not invest as an indicator. Great. So this was just a really quick run through across many kind of topics and dimensions that exist in this space. And I realized I would love to leave a little bit of time for Q&A, but just please keep in mind, this is just the introductory session, right? So we have 4 more sessions to go, and specifically in the second session, we'll talk with the traditional VCs and how why they are building the impact vertical, what trends do they see, what companies do they love to fund, how does their internal decision making and impact management assessment actually work. We will have the same discussions with this kind of new VC funds that are emerging. And then we will really dive into this kind of impact management framework, and then really think about how do we monetize impact as well. Because as you saw from the various trends, right, impact is not only a burden. Impact is a huge impact. It's a huge value generation machine. It reduces the cost of companies that want to, for example, for hiring, retaining, or motivating people. It will reduce the cost of capital because there's a lot of concessionary finance that will exist. It will create the risk, decrease the risk that you will be fined with, say, carbon taxes, right? Or your consumers will turn away from you because you're not diverse enough, or your company doesn't take advantage of the full creativity and potential of the workforce. So all of those questions about like how do we actually leverage impact, kind of monetize it, and how do we create those impact premiums both for startups and for the investors, that will be part of session 3. And then we'll put all of this together in the last kind of session, where we in a way bring out the lessons and very practically say, okay, those are the steps that you as an investor or as an entrepreneur can now take to build your impact management system up and get it operational, depending on the maturity of where your processes already are. So with that in mind, thank you so much for your attention. It was an absolute pleasure, and I'm very much looking forward to the Q&A. Please, it's my favorite part, so please don't hold back with any questions. Thank you.
Thank you so much, Wladimir, and I'm glad to hear that you said it out loud, that impact is not just a burden. So I hope that everyone listens to this, because it's a very important message. As you know, when we had the registration going on, people had already submitted several questions. So I will try to be managing questions that show up in the Q&A, and I will start, because I see some coming up, and I will start with some of those that we received in advance. And the first one. In your opinion, which approach do you see most feasible and practical for determining indicators that measure impact?
So if you are trying to just find the indicators that other people will agree with you are actually proper indicators, I would really recommend looking at the GIN network and the IRIS Plus framework, because they really work like for decades now, standardize the vocabulary of how we talk about impact and which indicators to use. If you talk about the methodology and you want to have something practical that gets you to an impact score fairly quickly, I would recommend looking into the impact multiple of money. because I think it allows you, like once you've done your theory of change and you kind of know what your output and outcome indicators are, you can actually then create this quantified factor, and you can then project your impact into the future depending on your growth expectations of the company.
Okay, I saw I was muted. How would you communicate impact versus profit and scaling when you pitch?
Yeah, this is such an important question. And here, my main message to you is stop apologizing for impact, right? Like challenge this dichotomy that it's a trade-off, because it is not, right? Like it is going to be one of the most important things that's going to help you build the company. It's going to, again, like, I briefly mentioned it, but I think it's so important to just kind of reiterate it. It's really going to help you win the war for talent. Like there was never been a more intense, in a way, fight over getting the best people into the company. If you can prove to people that you work on something truly meaningful, on a hard problem that deserves the attention of those people, that's really a great sales pitch that will help you, lower your cost of capital or get some of the best people on this planet. And then the other thing you should also be aware that consumers, right? Again, the generational shift is quite strong. There's an overwhelming amount of evidence that consumers want to partner and buy from companies that do good. So if you can measure your impact and if you can maintain that genuine impact level, that again helps you retain your customers, right, in a more predictable business model. And lastly, you can point to capital, right, the cost of capital and the interest of investors down the line, whether it's for loans or whether it's for equity investment or whether it's for social impact bonds. It's going to be way higher if you are a genuinely impactful company than if you're just kind of, let's say, like a normal kind of responsible company.
Okay, next question. Would impact not become the main criteria to raise capital in general? So
this is an almost philosophical question about, I think our economic system will transform, right? So maybe if you would allow me, I would take a step back and just say, look, let's return to what capitalism as a whole is. It's an optimization machine, right? So depending on the indicators that we reward, our system really, like, its strength is that it optimizes for it ruthlessly, but its weakness is that it disregards everything else in this optimization thing. So if we optimize profit and revenue and shareholder value, that's what we will get. So far, we have actually been, we have started, but we are not finished building the type of impact indicators that we need to help our system optimize for something else than only profit, right? We can measure financial impact really well, but we cannot really measure environmental and social programs really well. So the more kind of ESG and impact indicators, the more we mainstream it, the more it is likely that impact will become one of the most dominant, in a way, considerations when actually raising capital. Having said that, I think it's also important to note that not all companies will be pure impact companies, right? So there will be a lot of companies that are just going to be responsible. So, for example, I had a chat today actually with an investor, and she said that she invested in a company that is just a great online meeting tool, right? So it's a company that I would say is neither like specifically super impactful, although it's good that people can meet online, right? But it doesn't solve any of the SDGs to that extent. But that's also fine, because our economy also needs those companies that might just be responsible and neutral and treat their staff well, as defined by the ESGs, but not necessarily have this kind of like kind of world-changing impact considerations at the core of their business model. So I think what I would expect in the economy is to have everyone be at least responsible, and then some part of the company really focusing on impact, really building those impactful businesses. And for them, there will be specialized investors that will help them scale.
Okay, now I will go to one from the chat. When we talk about conventional VC funds investing in climate tech, what's your view on those investors' capability to measure and control impact, including negative impact trade-offs or even basic ESG minimal safeguards?
Yeah, well, this is a great and fairly long question. I wonder, could you just give me the first part of it just one more time?
I will read it again, it's very long.
Yeah.
When we talk about conventional VC funds that are investing in the climate tech space, what is your view on those investors' capability to measure and control impact, including negative trade-offs? I think the other part is building up, so this would be enough for a...
Yeah, no, that's an excellent question. And I think, look, we have to look, what you will see a little bit is also a need within those VC funds to build up the necessary capabilities, right? If you look at the current staff composition of VC funds, those are a lot of them come from finance backgrounds, management consulting backgrounds, maybe the private sector. Very few so far come from roles that would have been much more involved with measuring social impact, right? Like maybe kind of development workers or economists and so on and so forth. So I think what you will see is there will be a hiring drive actually to have more of those profiles and actually integrate those impact considerations into the decision making of funds. But after that, and there is already interest, right? Like also from the Immerland side, we are already working with some organizations to actually do that. And I personally find this quite exciting because on the other hand, those VC investors, they usually have quite a bit of power when it comes to the way they interact with startups, right? They actually provide a lot of the financing. Usually there's one lead investor, like if you have a financing round, the lead investor would roughly do 60 to 80% of the whole round. If that investor is really, really serious about impact, then in the term sheet already, right? And I know this is already happening, you can integrate considerations like, we want a more diverse management board, or we would like you to report certain data points to us, not only financial data points, but also like, maybe on the environment, or maybe in the way you treat your workers and so on and so forth. So I think there is quite a bit of power. And what will be very interesting to see is how the entrepreneurs actually react to that pressure. Because entrepreneurs, like, again, they might say, well, if you force me to report impact data, I will just go to another venture capital fund, right? Who will not force me to do that. And so, but if all entrepreneurs say, you know what, actually, I want to do it myself, and this is great, I want to have this genuine impact partner on this journey, then, then those more impact-driven VCs will actually win because that's a competitive advantage. But just kind of like summarizing, right? So there needs to be more capability building within the VC funds. And then you will see like a small split between VC funds that take impact seriously and between some that don't take it seriously. And the question of like who will fare better actually depends on the preferences of the entrepreneurs. Because if the entrepreneurs are committed to impact, they will actually side with the more impact-focused VCs. And then as a result, those portfolio companies obviously will increase, right? Because the best companies will work for the impact-driven VCs. And you might be muted, Luisa.
I'm trying to use both technologies for the question. So it's one is about the use of SDG metrics to measure impact and whether you would recommend it and whether you think it's an easy tool or not. Yeah, SDGs, again, like I think they're absolutely critical because they are our common language, right? To talk about where we want to go. So if I can talk to you about like, SDG, an SDG focus on poverty, you know exactly what I mean. We understand which indicators we're trying to address. So it's really important. But the problem with the SDGs is that they are large, they're really huge, right? Like ending hunger, right, can be done in so many different ways. You can link almost every activity to an SDG. So, and you should actually link your activity to SDGs. But impact measurement will really have to focus on the relationship between your output and your outcome, right? So this is just really important to take away. The SDGs will be the higher level goal that you will want to achieve, the ultimate impact. But really, what your impact management should focus on is how the product you provide, right? Your output. Is it a training? Is it a good? Is it a technology? How does that influence the next outcome indicator that actually changes the world a little bit, right? Does it improve reading scores? Does it reduce emissions? Does it decrease the time people have to spend on some burdensome tasks? Whatever it is, like those outcome indicators are the true measure of the impact of your product, right? And then you can link them back to the SDGs. But just know that the SDGs are in themselves not quite enough to do a proper impact management system. Okay, so that's a very specific question. And Are there strategies for reporting impact when the tracking of outcome data is done by your customers over whom you do not have leverage to report to you?
Yeah, so that's a great and very common issue, right? That in a way you need the data of your customers to figure out whether your product actually works. And I think here you should be very pragmatic, right? Like, and here statistics is really your friend, because you can do like a randomized survey with just a very small fraction of your customers, and you would get a really good idea, right? Of the kind of outcome indicators you care about, right? So I think in the beginning, you don't need to be like, there's all kinds of experimental designs that you could do. I think this is like way too complicated in many instances. If you care about an outcome indicator, like for example, again, something like how much time do you spend on a certain task? Just send out a survey to your customers, right? Like once every quarter at random, 100 people. This will already be enough. Offer them an Amazon voucher to just take the survey and kind of be honest about it, and just see what they say, right? Like what's the reduction that they actually witness themselves. Having those small indications already will help you fine-tune your product, and you should do that anyway, right? But it will also help you communicate the impact that you have and how you're actively managing it to the stakeholders who might be interested in it, and that might be your investors, your customers, and also your employees.
I'm sorry, because I'm also reading all the questions that are showing up in the chat. Yeah. How do you see geographical focus from VC funds? Do they often try to focus in one or two regions, or they tend to be more agnostic about location? And if so, which areas are most exciting?
Yeah. So there are some investors. I mean, I think we had on the slide, we have here Blue Dot. They say like we do climate tech, right? I think if you would speak to them, they would probably say, look, we are also very broad. Like climate can be interpreted in kind of in many different ways, and maybe you could have like almost like an education program, that teaches you about climate. That would also be a good investment, right, for them. So I think VCs have quite a bit of leeway in terms of how they define the scope of their funds, and they can be quite opportunistic about it as well. And which is not a bad thing, right? Like at the end of the day, their mandate is to make a return, and if they see a really great team and a really great product idea, they will just go for it, because like, they don't want to leave kind of money on the table. There is more and more, I think you see because of the investments that investors make, they are starting to build up a certain expertise, right? So again, if you take someone like Blue Dot, like if you would even raise money from another fund, this other fund might actually recommend for you to talk to say a climate focused fund, because they want to get the opinion of the climate focused fund on your venture, because they themselves might actually not be the biggest experts in it. So you see a little bit of like specialization. You see a lot of specialization among the funds, also paired with a little bit of ability to increase the scope of their mandate once there is a really good opportunity that came their way. And then the vast majority of funds, I think, will still be very diverse. So they will kind of take advantage of a huge set of different impact verticals. And I think the most attractive of those will probably be climate/green tech, agricultural tech, health tech, and then education. Those I think will like are really kind of fast growing in a way verticals that will get more and more funding in the future.
Okay, next question. This is from someone, and I'm going to read it because I think it's easier. When we were raising, we were quite often classed as an NGO, and we found that VCs were really scared of being associated with anything that reminds them of a charity. So we have started a new impact-oriented company that puts impact first, and we are raising from foundations now. We really haven't found the perfect fit for a climate tech company that also has a social mission. Where do you recommend us to look?
I mean, here, I think the interesting question is like, why, I guess, in the situation, they were labeled as an NGO, right? Because I think an NGO is a very specific business model where you actually you rely a little bit on grant funding to finance your operations, then you do something good. Whereas I think for a business, you should have like a bit, right? Like a business model. And Rita, please correct me if if that was included in the question. But I guess my point is like, if you have a business model where you participate in some form of market, then you provide the goods that people want to buy, and you can show how this is solving a really important pain point, and you can scale a lot. I don't think that you should be labeled as an NGO. You should say like, we are a really profitable business that also has a huge impact potential to us, right? So I guess it would really depend a little bit on the situation. What I have personally also experienced, especially when building Immerlearn previously, is that if you label yourself a social enterprise, then for some reason people might think that you are not that serious about the profit mission, and that you kind of want to do a trade-off. But here again, I think you just really need to make clear that there is no trade-off in your case between the profit and the impact.
There's also another issue, which is in many countries, it depends on the legal framework. For example, in some countries, we have some of our alumni that they are both an NGO to be able to get into some opportunities, and then they are a for-profit, because it enables them access to other opportunities. But that is another topic. I will go to the next question, which is, sorry, how do you build monitoring systems to make sure that the VC's impact targets are achieved? Will there be impact measurement taxonomy to certify impact achievement, or what remedy will VCs have to exit companies that do not live up to expected impact targets?
This is such an excellent question. And I think one of the key questions out there really, right? Like imagine, like, for example, like you could have a very common situation that happens with startups, is that they pivot, right? They realize they had a certain idea, a certain product, it worked for some time, they realize they need to pivot. That pivot might actually be in a direction that is not really impactful when the previous direction was really impactful. So at that point, what do investors do, right? And I think here there is no clear standard yet. It's going to be very hard in that situation for an impact investor to just withdraw their money. It doesn't really make sense. So it will be interesting to see, especially with those kind of pure impact VCs, what happens in those cases. So it's not 100% clear yet. There's not a lot of pressure mechanisms that I saw in kind of contracts that VCs can apply. Like when you sign essentially a kind of an agreement with an investor, you do have certain obligations in a way of say financial reporting, right? You need to disclose what your cost structure is, who you've hired, and so on and so forth. That's just part of your normal disclosures. To the extent that impact disclosures will become part of this framework, you will have a legal obligation to actually measure those things. And if you don't, then I think the VC investor can essentially just sue you, right? And say like, okay, I want my money back now, and like I will not participate. You're kind of breaching the contract we have in the first place. I think that will be a standard at some point. But again, I think just it's a theoretical possibility, but it will not happen a lot because no one has an incentive to actually escalate that situation. Neither the startup nor the VC who put their money there in the first place.
So Wladimir, I would have still a very long list of questions, but since we still have 4 sessions ahead and it's 6 o'clock, I would say we'll leave some of the other questions that might be automatically answered in your 4 sessions. So I hope to see you in the next session in 2 weeks' time. Thank you so much for a great session, and thank you for having been with us. And there's a small survey on your screen that we would like you to answer. Thank you, and wish you all a nice evening, and see you in 2 weeks' time. And to Wladimir, thank you, and you'll get to answer all the other questions.
Thank you for having me. Thank you so much.